Hey ladies and gentlemen, and welcome back. Thank you for watching and your continued support. Today we're going to get stuck into perfecting the art of a stop loss. Now it's a term that you're all aware of, but it's an art or a skill in terms of utilizing a stop loss effectively that not many of you actually have the grasp of and not many of you are effectively using. Now you may be watching this video thinking, oh well, I place my stop loss, I have a strategy for it, but I'm going to unpick some of that today because there's a chance that you're not utilizing it completely or as efficiently as you can, and the different variants as well on when to be a little bit more aggressive perhaps with a stop loss, or when to be a little bit more lenient, but all will be broken down into today's video with obviously practical market examples so you can implement them straight away and start making a positive difference to your trading. Let's get stuck in. So before we jump onto the charts, I just want to start with one of the biggest things I see that is really bad out there, and where a lot of people are going wrong, but a lot of people are commonly doing. A lot of people have their strategy and their plan, and when it comes to stop loss, they use the same stop loss every single time. So they might have allocated a 20 pip stop loss, a 15 pip, a 40 pip. You get the picture. There's a certain allocation, a certain number for their stop loss every single trade, which is absolute criminal. It really is, because every trade is completely unique. Every trade is completely different in terms of setup, in terms of take profit levels. When you hear or see people who have on every trade they aim for the same amount of pips and they have the same amount of stop loss, that is really not healthy habits in trading, I can assure you. Every trade is completely unique. Every trade should have an individualized stop loss worked out for it, based on your risk tolerance, which we're going to go into today on the chart, so bear with. Because every trade is completely unique, and again, certain trades we will be playing out for longer and holding for longer, and other certain trades we may be a little bit more intraday, maybe a little bit more in and out. So it really does depend, and we're going to go through those different examples now. So 1% should always be calculated of your actual account balance. Now I know that sounds super basic, but again, so many people, let's say they have, again, let's pick an easy number. Let's say there's £100,000 in their trading account and they risk 1%, but they've just had a trade that's hit a stop loss and taken their account balance down to 99,250. Typically then traders, and this can be any account balance of course, typically then so-called traders, they want to then be still allocating 1% off 100 grand, when actually their account balance isn't 100 grand anymore. You need to be continually reassessing before each trade 1% of your actual account balance. Obviously the account balance will always fluctuate. We hope it obviously goes up with time, but you get the picture. Because if you start then allocating 1% of 100 grand when actually your account balance is 99,250, for example, you're then opening yourself up to more risk. You're actually risking slightly more than 1%. So you can see then how it can become a bit of a spiral and can start getting a little bit more murky waters. So that's one of the big things I would just nip in the bud for you guys, is please just make sure you're continually individually assessing. You know, if it's 1%, for example, you are continually assessing what 1% is of your actual live account balance, not your account balance from 2 trades ago in the past. It has to be your live account balance just before you're taking that trade.
So guys, using our first example, it's going to be an example of a bearish market when taking a short. I'm going to use the DXY just because, well, you know, the US dollar is a world reserve currency. Yeah, it's a brilliant thing to be looking at and very helpful for you. Now, just a bit of context, we're obviously in a bearish market, lower lows, lower highs, lower lows, lower highs, and we're now obviously looking to form a next lower low. Now this is currently live price as I'm filming. This is no replaying, this is live price. You can see, guys, a live example. So bear with me, I'm just going to scope out the potential area of interest. Let's say we were analysing this last week after this lower low had formed. We'd be wanting to fib that new bearish leg and starting to work out a potential area of interest of where price may retrace to. So we've clearly come off the 61.8 here, in around 13,000 as well. So that's fine. So in this example, if we're looking at our area of interest being around the 61.8 fib, that's fine. So this region here. Now, if we go and look at putting a short position on, just from around that area of interest, go into our fib extensions. Now, guys, I will be doing a separate video on Fibonacci's and the massive importance of them. But I'll save that for another day, just so we can keep focus purely on stop losses. So, you might be thinking now, right, stop loss, where does it go? Does it go just above to keep a tight wrist? Does it go here? So, first things first, let me just pop it there, or let me delete that for a second. So, first things first, this is for any example, whether it's bullish or bearish. We need to establish where the 78.6 is, okay? And then we also need to establish where the most recent prior swing point is. So that means in a bearish market, the most recent lower high, which would be here. So we've had a lower high to a lower low to a lower high to a lower low, and obviously now after this here, we were looking to form our next lower high, which we formed. And so we need to establish where the prior lower high was, because that is the most significant piece of recent structure. So basically what I mean by that, if price decides it wants to break above here, then if we saw that, and that doesn't mean on the 1 hour or the 4 hour, this means on the daily, so it's more trusted and there's more weighting to it. If price was to break and body close above this level, then we would see a trend change and we would see this market turn bullish, most likely. Not all the time, of course, but majority of the time. So once we've established that most recent swing point, and once we've established where the 78.6 fib aligns with, now these two things will always be very close to one another, always. And this is why this is a super effective way of where to place your stop loss. So if we go back to then popping on the short play, oh, that's the fib region. There we go, 1-1. So if we look at, let's say this is where we were looking at that area of interest. Obviously we're going targets into the second or first fib extensions. That's fine. Again, we'll save that for another video in terms of take profit levels. Now, we don't want to pop the stop loss on the 78.6, because if we pop it there and price decides to push up, which it would be well within its right to do, if we pop it there, we're going to get stopped out prematurely. We need to allow the trade enough room to breathe. And again, if we stop it at the most recent swing point, again, price would be well within its own right to push into the most recent swing point and to push into the 78.6. And because they're normally very close together, again, we need to allow the trade enough room to breathe. Because if price did do this, and it did, let's say it didn't react off this and it pushed higher before then melting off, which we do see, it does happen, we want to make sure we don't get stepped out prematurely, because I bet those of you that are watching this, you've all been in trades before where you've been stopped out and the trade has ended up going out or playing out in the same direction that you called, and it's hugely frustrating. It's sometimes more frustrating than taking a loss is. So we need enough room for the trade to breathe, but obviously then the flip side to that is, well, how much room can we give before without exposing ourselves to too much risk? So that's where we come on to then. You need to give enough clarity and enough clearance from the 78.6 and the most recent swing point. Now we get wicking, of course, as you can see, we always get wicking. Wicking is a normal part of trading. So we typically want to be allowing that stop loss to be just about enough room to clear that, like I said, most recent swing point and the 78.6. So that way, if price decides, as I've said, to push up, but then starts to consolidate and starts wicking and starts rejecting and slowing down before then dumping, brilliant. We've given it enough clarity, we've given it enough clearance, and we're all okay. And as you can see, guys, that is still a risk to reward of a 1 to a 3.2. So it's a fantastic risk to reward. It really, really is. So that would be what we would have in a bearish market. That would be an example like that. Now, again, whilst we're still on the topic, let's just get rid of this. Let's say, and this is where other conferences come into to play. Let's say you had marked out the 50% instead as your area of interest, because you'd be well within your right to, because there's prior structure there, and so on and so on. And this is why, guys, you shouldn't really set sell orders or buy orders. You need to be setting alerts, but you need to be watching live. You know what? You need to be watching price live at the time, because if we'd maybe looked at the 50%, we could see the 4 hour here has had a lot of momentum pushing into it. So you'd immediately be thinking, right, well, there's no slowing momentum yet. Again, the next 4 hour candle broke above it and closed above it. So again, there's no slowing in momentum yet. It's only here and here where we start to get some slowing and some indecision. And that's where if we go one more onto the 1 hour, that's when we start to see some 1 hour selling candles. We had another push higher, and then followed by obviously then a proper sell-off. So you need to be watching price live. Well, in an ideal world, you do. That would be my advice, at least. So hence why you would look at maybe pushing into 61.8 instead of 50%. But let's say you had set a sell order. If you were then, oh, it's a fib again. I've done it again, guys. My apologies. Let's say you had gone off the 50%. You then, if the risk to reward is still good enough, this is why I'm a big fan of swing trades, but if the risk to reward is still big enough, then you still could afford to have your stops at around that previous region we talked about. Now you're still getting about a risk to reward of 2.8 there, 1 to 2.8. So still pretty damn good. But let's go back to prior example. Let's say it was at the 61.8. So once you now have that potential area of interest set up, you've got your fib level in there, you've got your area of interest that you're looking to execute from as long as price gives you those confirmations. You now know this gives you your total amount of pips. Okay, so you now need to then work out what that means in terms of 1%. I'm biased and I use an app like Stinu, but there's plenty of calculators out there. So what you would then do once, like I said, you've had this area of interest scoped out, you would pop your account balance in there. Again, as I said earlier on in the video, the actual account balance. You would pop the size of the stop loss, the amount of pips basically. You would obviously put in what pair you're trading. For example, here in this example, it's the DXY. And then you would also lastly put in the amount of risk that you want to tolerate. So for example, again, as we used earlier in the video, it'd be 1%. And it would then calculate the amount of lots or the size of position, should I say, that you need to enter with to make sure that you're only risking 1%. So I would always use a calculator. I would always do that set of calculations for every single trade. So you can see why, guys, you shouldn't just use a bog standard 20 pip stop loss, 40 pip stop loss, 60 pip stop loss, because it's going to really vary every individual and every single trade. So please don't do that. Please do these individual calculations for every single trade. So guys, let's turn our attention to a bullish example, and I've chosen gold because I know a lot of you love gold and have a particular interest in it. So bullish example, we are currently on the 4 hour, but at this stage in time, at the time of this trade or the time of this price, the daily and the weekly are also bullish as well. So again, we're singing from the same hymn sheet on all the higher time frames. So again, let's just say we've established that leg to the upside has now finished. We're starting to pull back, as you can see here. Now we know that gold loves the 50% and the 61.8, so we'll keep those levels on for now. The most recent swing point on the 4 hour, of course, we just need to scope out, which would be here because this is our higher low, and that is we do that structure point at the bodies, not the wicks for this when it comes to structure points. And so again, we're now just looking, there's other conferences in there as well, but again, I'll save that for another video. So we've marked up our area of interest. We're thinking somewhere in and around 50%, around the 61.8. We've got some prior structure there as well. So we'll just mark that out. Now, of course, there's many other reasons and conferences and details to why we're establishing this. But as I said, I don't want to go off topic too much. I'll save that for another video so we can just, again, keep focusing on stop losses. So let's just let price play out at the time. Price has come down to there. I'm just going to pause it there. So before, obviously, let me just go back actually. Select bar. Let me just go back. So we just come to that retracement. We'd worked out our area of interest. That's fine. So again, working out the position. So we want to get not a short position. We want to get a long position. So let's take the 61.8 for example. You'd worked out again. So we use the same example as earlier. Where's the 78.6? Where's the most recent bullish swing point? Obviously in a bullish, because we're in a bullish market. And again, you would give yourself just enough clarity for that to breathe. And again, fib extensions. we'd go into fib extension number 2 in an ideal circumstance. So that is a risk reward of a 2.83, really, a 1 to a 2.83, so brilliant. We then let price play out. Do we see a reaction off the area of interest? Yes, we do. And price forms then its new higher high into the minus 27%. And brilliant. Great trade. You've taken there literally 500 pips. You know, and this is why I know gold, a lot of you love it because of the opportunity it provides. But again, this is where you see it gives it enough room to breathe. Because as we all know, gold is very, very volatile. Let me just delete all of this. Gold is very, very volatile, as you all know. And there's no reason why, actually let me pop that fib back on. There is no reason why, in this example, that gold, if it wanted to, could have pushed down into here, as sort of as a double bottom, if you like, on that prior structure, or as I've said earlier, the 78.6, before then pushing up. So, and this is why, and a lot of you will be thinking, well, Philip, that's a massive stop loss, because we're going from 2334 to 2332, so that's 120 pips stop loss. This is why you have to calculate, because on gold, this is where again where a lot of you go wrong. On forex pairs, you know, instead of commodities, it's really different. On forex pairs, a lot of you again might use a 30-40 pip stop loss, and I've already obviously explained why you should be using a standardized stop loss for each trade. But on commodities, you know, we get a lot more volatility on gold. You have to have a wide enough stop, otherwise you'll get stopped out prematurely. So your lot sizing on commodities typically should be a lot smaller, because typically on average, not all the time, but on average, your stop loss needs to be slightly bigger. Now, just because your stop loss is bigger doesn't mean you're opening yourself up to more risk. It just means reduce your lot size. So you're still only risking 1%. And this is where so many of you go wrong. So many of you love trading gold, but so many of you are making such simple mistakes like not reducing your lot size. You keep the risk the same, brilliant, but you don't keep your risk the same, I guess, because you're not reducing your lot size. So you really have to, as I said, it comes back to the same point of this video. You have to calculate what 1% is for each and every trade, okay? I cannot stress that enough, because if you cannot nail your risk management, you will never, ever, 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 ever be profitable, ever.
So guys, as always, just thank you so much for watching. It's hugely appreciated, your support. I'm getting lots of positive feedback. If you found this video helpful, please, of course, subscribe, give it a thumbs up. It massively helps the channel and gets that proper content out to the right people as well, so we can help as many people as possible. If you need any further assistance, please feel free to reach out. If you want to work with me, links are in the bio. Take care, guys, and I'll see you on the next one.